Okay, let's dive in. Welcome to the deep dive. Today, we're taking a close look at the recent Q4 and full year FY25 earnings call for Healthcare Global Enterprises, HCG. And, well, the overall vibe from that call, definitely positive. Strong results, optimistic plans.
Yeah, that's exactly right. Management really laid out a case for solid execution. You saw it especially in their core HCG centers.
Right.
And that translated into some pretty robust numbers, both for the quarter and the whole year.
Okay, so let's start with that quick snapshot. What were the headlines?
Well, you had really significant year-on-year revenue growth. That was a key theme, driven, like I said, by those core centers.
Okay.
And crucially, it wasn't just revenue. Adjusted EBITDA grew strongly, too, leading to, a healthy margin profile overall.
Which really underlines the strategy they've been following, doesn't it?
Exactly. It seems to be paying off.
All right, let's get into the nitty-gritty then. Can you walk us through the specific financials and maybe some operational highlights from the call?
Sure thing. So for Q4 FY25, revenue hit INR 585 crores. That's 5.85 billion rupees. Nice expansion year on year. For the full fiscal year FY25, revenue landed at INR 2,223 crores. So consistent performance there.
And profitability, the adjusted EBITDA.
Right, the adjusted EBITDA. For Q4, it was INR 106.9 crores. That gives them an 18.3% margin.
18.2%, okay.
And for the full year, INR 396.3 crores, which works out to a 17.8% margin. Pretty healthy, and they actually expect that to improve going forward.
Solid numbers.
Yeah.
But what's happening operationally? Patient flow, treatments.
Yeah, this is where you see the engine behind those financials. Outpatient footfall, up quite a bit, 13.8%. More people coming in.
That's significant.
It is. And chemotherapy sessions, a direct measure of activity, grew even faster, up 24%.
Wow.
And even though they added new LINAC machines for radiation therapy, utilization stayed steady at 60% in Q4. That means they're putting that new capacity to work pretty quickly.
Okay, and what about bed occupancy? I noticed that figure was a bit lower compared to last year.
It was, yeah. Currently 54% across the network. But management was clear this is really just a result of adding beds. They brought 235 new beds online.
So the denominator effect.
Exactly. More beds available, so the percentage naturally dips a bit as they ramp up. It's totally within their expectations for this kind of expansion.
Makes sense. Now, you mentioned operating leverage earlier. Breaking down performance by center type, established versus emerging, that seemed really key on the call.
Oh, absolutely. This was maybe one of the most interesting parts. Your established mature centers, solid, 22% revenue growth, 15% EBITDA growth. Good, steady business.
Okay.
But the emerging centers, the newer ones, they're scaling up. Really remarkable numbers. 32% revenue growth.
Which is already strong.
Right. But get this, 44% growth in EBITDA.
Wow, okay. 44% EBITDA growth on 32% revenue. That's the operating leverage you're talking about, isn't it?
Yeah.
How does that work exactly?
That's precisely it. When your profits grow that much faster than your revenue, it's a classic sign. It means as these newer places get busier, their fixed cost rent, core staff, the basics aren't really climbing at the same pace.
Right.
So each extra bit of revenue, each additional patient contributes more significantly to the bottom line because those fixed costs are already covered. They're becoming much more efficient as volumes rise.
Okay, that clicks. So the existing setup just gets more productive. What about ARP, average revenue per patient? Any trends there?
Yeah, network-wide, ARP was up 4% year on year. It reached INR 44,236 in Q4.
Okay.
But here's another interesting split. Established centers were a bit lower, INR 42,595, growing about 2.5%. The emerging centers, though, they clocked in much higher at INR 56,755 and grew faster by 12%.
Huh, higher ARP in the emerging centers. That's a bit counterintuitive. Any idea why?
It could be a few things they touched on. Maybe some newer centers are in locations attracting patients needing more complex, higher value treatments, or maybe their case mix is just skewing that way.
Or location.
Definitely location. They mentioned huge variation. Metro centers like Bangalore, Ahmedabad, ARPs can push towards INR 1 lakh. Tier 2 cities, more like under 35K.
Big difference.
Huge. And they expect overall ARP to keep climbing, maybe 7-8% a year. That's likely a mix of pricing and attracting more complex cases.
Got it. There was also a quick mention of receivables ticking up temporarily at the end of March.
Yes, a minor point. Mainly some collections spilling over into April. Happens sometimes. Timing of payments, especially government or insurance.
It's sorted now.
Largely, yes.
Yeah.
They said things were back to normal in April, around their usual 105, 107 days sales outstanding. The MGM acquisition also nudged the number up temporarily.
Okay. And tax rate. Seemed high in Q4, but lower for the year.
Yeah, the Q4 effective tax rate was 50.3%, which is high, but for the full year FY25, it was 14.3%. They're guiding for about 30% for FY26. The Q4 figure probably has some specific adjustments in it.
All right, let's shift gears a bit. Moving from the results to strategy and future plans. Big news on the investor front, right? KKR coming in.
That's a major development. KKR is acquiring the stake from CVC. Management framed it as getting a partner aligned with their long-term vision, suggesting it supports their growth plans.
And they haven't been sitting still on investments lately either.
Not at all. They recently acquired that MD hospital in Vizag, now called MGM. That really strengthens their position there and adds capacity. Plus, they added 5 new Linac machines across the network, investing in the core tech.
And looking forward, the expansion plans sound ambitious.
They really do. That new flagship center in Ahmedabad just opened 189 beds. That's substantial. They expect it to boost patient numbers there by maybe 30–40% eventually. Plus, 2 new centers coming in Bangalore in the second half of FY26, one in North Bangalore, tapping new areas, and another in Whitefield, kind of extending what they already have there.
And the overall target?
Over 900 operational beds network-wide within the next 3 years. That's the goal.
900 beds in 3 years. That takes significant capital. Yep. What's the CapEx plan look like for this year, FY26?
They've earmarked INR 286 crores for FY26. That's going towards building out the network and tech upgrades.
Okay.
And yeah, because of all these recent investments, acquisitions, new builds net debt is up by about INR 250 crores. That means higher depreciation and interest costs too, maybe around INR 25 crores more per year combined.
But the expectation is higher returns down the line from that investment.
Exactly. They're betting that scaling up this new capacity will generate strong returns over time.
And the new investor, KKR, might offer a way to manage that increased debt.
Potentially, yes. They explicitly talked about the possibility of a primary equity infusion, basically issuing new shares to bring cash directly into the company.
To pay down debt.
Primarily, yes. Reduce debt, which would then help improve the profit after tax, the PAT. They said a decision on that is likely in the coming months.
Beyond just beds and buildings, they also talked about some really advanced technology investments.
Right. This was a key point they stressed. They've got this Orbitrap astral mass spectroscopy system, apparently one of the first in the world.
What does that actually let them do?
It's a big step up for their precision medicine work. Think beyond just genomics, looking at genes to proteomics, understanding the proteins those genes create and how they work.
Oh.
It helps find better biomarkers, choose more targeted therapies, and really boost that whole bedside to bench and back again cycle, using patient data for research and applying research back to patients faster.
Sounds impressive. What about the digital side of things?
Growing fast. Digital revenue actually doubled in FY25. They launched an HCG app too. The expectation is digital becomes a really major channel for them, making it easier for patients anywhere in India to find them and connect. That's pretty crucial in such a fragmented market.
We talked about emerging centers, but did they call out any specific established centers doing particularly well?
They did. South Mumbai apparently had a strong comeback, 37% growth year on year in Q4. And Kolkata was also robust, up 22% in the quarter.
Good to see. And that Vizag acquisition, MGM, how's the integration going? Any initial blubs?
There were a couple of temporary things. They lost revenue from an Odisha government scheme, about INR 1.5 crore a month, which hit them, and some one-time diligence costs of another INR 1.5 crore in Q4.
Okay, so short-term impacts.
Right. But the target for Vizag, once things normalize and integrate fully, is a pretty healthy 25–30% EBITDA margin. They think they can get there in the next couple of quarters.
Got it. What about internationally? Sounded like some headwinds there.
The main issue was fewer medical visas coming from Bangladesh. That used to be about 4% of their revenue, so it had an impact.
What other areas?
Yeah, they highlighted their Africa Center in Nairobi. Performing well, good margins, 24–25%, and they plan to expand further there.
And to focus efforts, they're planning a divestment too.
Yes, the Milan business. They intend to sell that off this fiscal year, FY26. It's about concentrating on the core oncology and specialized care in India and key spots like Africa.
Right. One small point, there was mention of a transaction bonus paid to some employees.
Yeah, they clarified that. It wasn't HCG paying it. It was the exiting shareholder, CVC, deciding to reward some employees directly as they left. It was apparently approved by minority shareholders, but it wasn't a company cost.
Okay, understood. So pulling all this together, strategy, investments, leverage, What's the outlook for margins? Where do they see things going?
Management is guiding for EBITDA margins to move up from where they are now, around 18% into the low 20s.
Low 20s timeframe?
Near future, maybe the next 2 years or so. The big driver is expected to be that operating leverage really kicking in at those emerging centers as they scale.
Makes sense.
They did caution that, new centers ramping up might initially put a slight damper on that, but the trend is upwards. And profit after tax, PS, should really start accelerating once these investments mature and potentially if they reduce debt with that equity infusion.
Okay, let's zoom out. For you, our listener, tracking this sector, or maybe HCG specifically, why does this call really matter? What are the key takeaways?
Well, I think the call really shows HCG executing a very clear plan. They're tapping into this huge and arguably underserved cancer care market in India.
Right.
And their whole single specialty focus seems key. They claim it leads to better outcomes. They keep mentioning that sub 1% mortality rate, and that helps them win patients, even against big general hospitals in competitive cities.
And we're actually seeing the results of that strategy now, right?
Yeah.
That operating leverage isn't just theory. It's right there in the emerging center numbers, that 44% EBITDA jump.
Exactly. And you combine that tangible proof with a really clear pipeline of new hospitals, specifically targeted at high ARP cities like Ahmedabad and Bangalore. Well, you can see a path for potentially faster growth and margin expansion ahead.
Plus, you've got those potential catalysts lining up. KKR coming in sends a strong signal. Selling Milan simplifies things. And that potential equity raise could really clean up the balance sheet and boost the bottom line.
Lots of moving parts, mostly pointing in a positive direction based on the call.
All right, time for that segment where we put on our thinking caps for a moment. Remember, everyone, this is absolutely not financial advice. We are not recommending you buy or sell anything. This is just a wild yet plausible idea based only on what we heard in this earnings call.
Okay, here's the pitch. A high conviction long position in HCG.
Okay.
The core thesis. We think the market might be underestimating just how quickly and how strongly that operating leverage is going to ramp up in the emerging centers.
Right, the 44% EBITDA growth thing.
Exactly. Combine that with the impact of all the new capacity coming online, especially in those high revenue metro areas like Ahmedabad and Bangalore, plus ongoing ARP growth. Well, maybe those EBITDA margins could push significantly past the low 20s target management gave, maybe sooner than people think.
Okay, so that's the core idea with the outrageous angle on this.
The outrageous part hinges on that clinical quality story, that sub 1% mortality rate they keep citing, the investment in really advanced tech like the Orbitrap. What if that represents a genuine defensible clinical advantage?
A moat, basically.
Potentially. If it's real, sustainable, and patients start choosing HCG because of it, maybe the company deserves a premium valuation that it just doesn't have yet. That's the slightly more out there angle.
And the plausible angle that brings it back to earth.
The plausible part is it's tied to concrete things management actually talked about achieving, hitting that 900 plus bed target, getting the expected higher ARPs in the new metro centers, making Vizag hit that 25-30% margin target.
These you can track.
Right, measurable goals. Plus the very real possibility of debt reduction through an equity raise. That's a concrete financial catalyst. So the upside isn't just wishful thinking, it's linked to them executing on their stated plan, which could lead to earnings surprising the market.
Okay, so just to wrap up our deep dive on the HCG call, key points. Strong FY25, driven by the core business, solid operating metrics.
Ambitious but tangible expansion plans in key markets, serious investment going in.
Clear evidence that operating leverage is working right now in the emerging centers.
And those strategic moves. KKR, the Milan sale plan, the potential equity raise, all positioning them for what looks like future growth.
And again, just to be crystal clear, this whole analysis was based purely on the information from the earnings call we discussed.
We are definitely not financial advisors, and this is not financial advice in any way.
So as you digest all this, maybe here's a final thought to leave you with. HCG is betting big on both scale and quality. How durable is that claimed clinical edge like the low mortality rate? And maybe more critically, how much will proving that quality actually matter in winning patients and market share in India's growing competitive cancer care field over the next few years?
Something to think about. We encourage you to take this information, do your own homework, and reach your own conclusions.